Wrong. I'm Charlie. Welcome to Moving Home with Charlie, and thank you for coming.
Charlie Landing grew up in Sussex, is the founder of Best Agent and presenter of Moving Home with Charlie.
If you want to find one of these guys, look out for those compassionate professionals. All estate agents are not the same.
So Charlie, what would be your advice for people interested in buying new builds right now?
Don't overpay. Do buy, but don't overpay. That's why I say disregard the guff. Read into the numbers and look, and it's buried. The bad news is buried in the small print, okay?
Good evening, everyone. Welcome to the Property Press Awards.
They may or may not be telling the truth, but you should form your own view. Get out and view, get out and view, get out and view. You cannot be in a position to make offers and have the offers accepted if you're not viewing. Just be out there viewing. Pay attention to the back of the class. If you've not been watching my videos, I did one just a couple of days ago. Disregard the guff, guys. Good afternoon. Welcome everybody. I'm Charlie Landon. This is another live stream Moving Home with Charlie, and it's a very special one because this is a topic very, very close to my heart, which is not exploiting people in a financially vulnerable position by giving them more expensive products. Now, I am very happy to welcome a new guest onto the show today. Justin Moy, who is a mortgage broker from Chelmsford, who I've had no previous contact with other than on Twitter. And as a result of the videos I put out the last couple of days on Twitter about my very strong feelings about Skipton Building Society's product transfer offering for existing customers, it's kicked up a real hornet's nest of debate. And Justin very kindly was the only, actually there was one other, but I didn't have a chance to talk to him, the only mortgage broker who, when I invited someone to come onto the channel to discuss it with me live, Justin immediately stepped forward and said that he would like to do so. And as one of the minority of mortgage brokers on Twitter who's just been a grown-up about this and been constructive in his disagreement, I was very, very happy to welcome him on here. I've also got waiting in the wings Alex Groundwater, Housing Stig, as some of you know him, who is going to do his usual playing of the numerical mathematical umpire, and will be here to call out any mathematical buffoonery, and also actually has his own numerical analysis on this. But let me start, for those of you who haven't had the backstory to this, by going through the article which actually first brought this product to my attention and outraged me, made me furious. So let me just start with this. I'll put it on screen and I'll read it out to you. Mortgage, so this is on the Evening Standard's website. It was on Tuesday. Mortgages as low as 3.35% launched to help struggling, and this is the key word, struggling owner-occupiers. And they then say, but there's a catch. I think they should have said, and there's a catch, but never mind. And this is obviously a press release from Skipton Building Society, and it's important to just actually read it all very carefully. Skipton Building Society has launched a low-rate mortgage range aiming to support borrowers at risk of payment difficulties. This is so important to the context of this debate, right? To support, to provide help for existing borrowers. This is not for new buyers. It's not first-time buyers. It's not a mortgage product that they're pitching to the marketplace, right? But to support borrowers who are at risk of payment difficulties. So this is to me, this is what's crucial about the context of this conversation. The mortgage product will give owner-occupier Skipton borrowers approaching the end of their current deal and who will be financially stretched on current rates the opportunity to bridge their payments by maintaining a lower interest rate for 2 years. That's interesting choice of language there. Bridge their payments. The member only, which means customer only, I think, 2-year fixed rate deals include a 3.35% for rate for borrowers with a 40% deposit, which I think is a bit irrelevant because I don't think those guys are going to need it, but maybe, and a 3.59% rate for those with a 10% deposit or people with a 90% loan to value mortgage. And here is the small print bombshell for me. The deals do, however, carry a fee of 5% of the existing loan amount, which can be added to the mortgage balance. The society said the products present members with another option, And I'm going to challenge this point about it being another option, as if they have other options. Because if they have other options, you wouldn't choose this one, and the numbers will bear that out. And will not be right for everyone. Okay, yep, that's true. Will not be right for almost anybody, actually. And then there's the typical crap. Oh, it's crucial lenders offer as much support as we can. What they should have said is, as long as we can make as much money out of it as we can. And this is my problem. I don't have a problem with mortgage lending per se. I have a problem with overpriced products designed to exploit people in difficulty. And I will, after I've said this, my piece, I will shut up and I will let Justin have free range to speak for as long as he wants to in response to this. Okay, but let me just finish this point. So according to figures from Money Facts, the average 2-year fixed for homeowner mortgage rate is currently 6.4%. Right, the Society said the move extends the support it already offers. This is what's the disingenuous part for me. This is what riles me and gets my hackles up. Or through the mortgage charter. So in other words, the stuff that you have to do because the government's told you to, but it actually just, so that's, what are those? They're talking about the interest only option, going interest only, which let's compare that option, shall we, with this one. Through the mortgage charter, so interest only and extending the term of your mortgage, we can compare that one as well. Which many lenders have signed up to in order to help borrowers who may be at risk of struggling. Under the charter, lenders will offer adjustments to borrowers' payments, for example, temporarily interest-only mortgage, or extend the term of the mortgage to make payments more manageable. It's crucial that lenders offer as much support as we can to ensure borrowers remain secure in their own homes through these turbulent times. Yes, and I'm not doubting anyone's intentions that these are all intended to keep people in their homes, because that is in everyone's interests, including the lender's interests, and I know that too. But what is not talked about here is what the true long-term cost of this is. Now, all of these options I know, so whether you go interest only for a while or whether you extend the term, all of those options will ultimately cost the borrowers more money. And that I get, right? Going interest only for a while is effectively a payment holiday, but you're not increasing your debt. And extending your term will also cost you more in the long run, but is also not increasing your debt. So my problem is that they have this 5% fee. So what it's saying, I know I've repeated myself a couple of times, but what they're basically saying is, look, if you're not going to be able to afford your repayments when you come to the end of your current fix, we've got a great deal for you, which is 3.59%, which is going to significantly reduce your payments. And of course, stressed borrowers, not just financially stressed, but they're going to be stressed in life generally, are just going to go, reduce payments? Oh my God, yes. Whatever it takes, reduce payments. Now there's a fee. Okay, well, I can't afford a fee. And then let's just also rule out the group of people who might be in a position to pay a fee out of their savings or out of cash of $5,000. You're not going to do that because that would not be the most sensible option for you. You'd be better off to reduce the amount or to continue paying on a new fixed rate that doesn't have this weird discount stuff and an additional fee. So it only applies to people who can't afford their monthly payments and don't have reserves. Okay, and this is the bit that so many people don't understand is, in my opinion, deeply wrong. For providing you with this 2-year reduction in your payments, we do unfortunately have to apply an administration fee, which is 5% of the total balance. But don't worry, we'll just add it to your mortgage. Now, again, that phrase, don't worry, we'll add it to your loan, gets received one of two ways. By people who truly understand what it means, they go, well, hang on a second, let's work out that and see if it makes sense. And then there are people who just go, oh, okay, so I don't have to worry about it now. And those are the people who are going to be welcoming this deal with open arms. Haven't got to worry about it now. Okay. I'm almost finished. I will wrap up my beef at this point. My point is that whilst obviously this reduced payments in the short term is going to provide relief temporarily and a cash flow easing, it will, no matter what the circumstances are, unless people have got a windfall or a chunk of money coming in within 2 years that they know about, it will leave people worse off than they otherwise would have been with the other options at the end of the 2 years. Significantly worse off in terms of extra debt. So in other words, whatever level of stress or struggle they might have now that makes them want to take this product now will be worse at the end of the 2-year fix, unless their circumstances significantly improve in the meantime. But the other thing that happens is that in a declining housing market where prices are falling, their equity is also reducing. So in the event, and I'm finishing now, in the event that 2 years from now, when this lovely cheap deal that they've paid 5% on top of their loan extra for the privilege of a 2-year discount comes to an end and they can no longer afford the repayments after that and are forced to sell 2 years from now, they're going to be in a much worse position than if they sold now. Selling now might not be what they want. It might also be difficult. They might already be in negative equity. But it's still going to be worse 2 years down the line than it is now. And in the meantime, Skipton will have pocketed straight into their fee, so it's fee income, so it's profit, right? 5% extra on your debt, which goes straight into their bottom line. To me, fundamentally wrong. And people say, oh, but they have a choice. No. In real life, anyone taking this is because they don't have a choice. Because if they had any other choice, they would take the other choice. So I utterly reject the notion that people who would take this product do so because it's something that they have a choice over. And that's a debate I'm happy to have with Justin. And on that note, I'm going to zip it and now hand the stage over to Justin. Justin, welcome. Thank you very much for joining us. And I will just shut my trap now and talk.
Can we have that in writing? Thank you. And also thanks for the invite on today. Really appreciate it. I don't think anyone can argue your passion towards property and finance, irrespective of whether we agree or disagree on elements of it and the broker community. So first things first, I think we need to acknowledge that. What I said I wanted to do really was to perhaps not so much for Charlie's benefit, but for perhaps the audience that we've got who may, how can I put it, may be influenced by what they perhaps read out there, perhaps within articles that may not be representing the product properly. So if I can just very, very quickly run through where this fits within the 12,500 mortgage deals that sit out there and the 120 lenders or so that can help. So as you quite rightly said up front, this is a Skipton Building Society product transfer product. This is not for buying a property or for refinancing a property. This is simply to give an option for someone who's an existing borrower, one of probably three things that they could do with Skipton if they don't take the mortgage elsewhere. And there are effectively 3 price points. One is some form of kind of 2-year fixed, for example, with no fee. There'll be a 2-year fixed with a kind of quite standard industry kind of 999 fee that can be paid, can be added. And this is the third one on top. This is the one where you can say, look, we will take a chunk off the interest rate that's being charged to you. And in effect, we're going to swap it for a fee. So it's, in effect, it's an interest to fee kind of change or way that we're going to charge it for you. Because ultimately, for some people, it may be that they need those payments to be a bit cheaper the next couple of years. And as Charlie quite rightly said, it could be that there are some mitigating circumstances that would work for. Some of this, understandably, might be that we are looking at kicking a can down the road a little bit, and that we don't know where prices will be in 2 years' time. We obviously don't know where interest rates might be. That depends which way the wind's blowing this afternoon, perhaps. There's lots and lots of ifs and buts, but perhaps as a niche product for the right people at the right time, this might have a place. And we could be talking about possibly 20, 30 borrowers at the end of the day, out of however many Skipton borrowers are actually coming up for their renewal over the next few months. So I think what's really clear is it's a niche product. It's probably not designed for, well, it's definitely not designed for the mainstream market because it's not available to every customer. It's only available to Skipton borrowers who are coming to the end of their deal. And it's one of, I think it'll be 3 different options that they will have. So choice is very much the key here. Now, the particular product we're all talking about and we all have a view about is this one with the 5% fee. And I get it. You know what? I think if you spoke to most brokers, they would feel uncomfortable recommending in most situations anything with a fee like that. And for the majority of brokers that are either watching or certainly in the market, they will know about this type of pricing because this is very systematic of the buy-to-let market. And if you really want to dig deep in that, we have buy-to-let products that have got there's even the lender that's got a 9.99% product fee. So this is not something that's new for mortgage brokers. It may feel really uncomfortable for those who don't work in the buy-to-let market. Certainly, this is probably the first one we've seen in the residential market. So we know it's not going to have a massive impact on our business volumes. We know we're not going to get our doors knocked down and a queue, a bit like a Northern Rock savings rush for people wanting to scramble for a 5% product. It has a very niche position. It will be right for very, very specific people. And quite frankly, I think for mortgage brokers, we would only feel comfortable recommending it in very specific situations. At the end of the day, residential lending is a regulated field. And the only people that can really do this are either the regulated people within the bank or within Skipton, or the guys that are sitting in mortgage brokerages who can actually kind of deal with the Skipton deals. And because it's a residential mortgage, there is massive amount of regulation around the advice that we give, how we actually recommend it. So we've got to justify it to someone somewhere, be it a network or be it to the FCA if you get a visit, and that the borrower gets the protection of the Financial Services Compensation Scheme if the advice is deemed to be inappropriate or incorrect. So let's just put some bits of context around that, if I may. The product itself, right, it's not an admin fee. Let's get pricing very, very clear here. All this is in effect a shift of quite substantial amount off the interest rate that the lender is charging, and they've turned it into a fee. So whenever you're looking at whatever balance you're looking at, be it if your mortgage is £100,000 or £1 million, it's the same financial mechanics. And if I may, this might be a good time to put a slide up if that's okay. So forgive, I'm just going to share if I may, just share something I've put together here. Nothing more than just to try and highlight the thing there. So there we go. Right, okay. I appreciate, and I've actually got an interest only and a repayment slide here. So please bear with the example. Is it sophisticated? To a point, yes it is. All right, so please bear with us on this. What I've tried to do is try to illustrate clearly what a £300,000 interest-only mortgage would cost if you took the Skipton's no-fee product transfer option. So this is the same customer, the £300,000 mortgage. They come into this decision that they need to do something and they need to stay with Skipton. If I take the traditional no-fee option, that's the left-hand side. So what you've got there is you've got the current product, 5.99 fixed for 2 years. So the pure interest cost on that is just short of £1,500 a month as a mortgage payment, and over 24 months, that's just coming up to £36,000. That's the kind of traditional option. Yes, there will be one with a fee, a small fee and a lower rate, I get it, but just for comparison purposes here, with a fee stroke no fee situation. The one on the right-hand side, in red as well, is what the situation would be if that same person, for whatever the circumstances and situation, took the product that had the 5% fee. And I've assumed that the fee is added. Because like you said quite rightly, if you could afford the fee, then actually why would you be doing this? Totally agree. So let's just assume the situation means it's got to be added. So what I've done is I've assumed it's added, and then I've worked out the interest for the next 2 years. And the total interest, as you can see, is about £14,000 less, nearly £15,000 less over the 2 years. You then add in the product fee, because it's obviously a cost of what's occurred here. The mortgage payment is substantially less. So I think that works out to be, if my maths is correct there, nearly £620 less per month for the next 2 years. If you appreciate that, although Skipton will be lending it out at 5.99 as a 2 year deal, they are making a loss at 3.35. Where they're recouping the loss is the 5% fee. And if you actually work through the maths, you'll look and say, right, well, 5% over 2 years is roughly 2.5% per year in a swapping interest to a debt, or sorry, interest to a fee. In fact, there's actually a little bit less than that, a little bit more than that in terms of discount off the rate. But even if you add on the fee and you add on the interest, so there's a compound value to that, the overall cost for the 2 years, and to be fair, when mortgage brokers have to prove why they have done a particular product with a particular lender and whatever, the total cost to pay over the term of the deal is by far the most popular and the one that's actually probably prescribed in most situations. So when we do that assessment, so we've added the interest, we've added the fees, we've compared it to a alternate product, certainly in-house, the cost over 2 years is only £165 more. And for the people asking what's the outstanding balance of 2 years, one is 300,000 on the left-hand side, the other one is 315 on the right-hand side. But don't forget, you have paid £14,500 less in interest. So yes, you have a higher balance. Get that? We're not hiding that. We're not saying that that doesn't exist. But what you've done is you've swapped nearly £15,000 worth of mortgage payment for £15,000 worth of fee, which has been added to the mortgage. Yes, that fee has got to be paid back at some point. That's then when you've got to have to debate, is it about tagging it to the end of the mortgage? Can you do some overpayments? Can you perhaps put a bit of it on repayment and some of it on interest only in this circumstance? That's perhaps how we look at it. If I may, before comment, there's a repayment version. Slightly different context here, because with the repayment mortgage, as most people will know, the mortgage payments, obviously the differential is not purely just the interest. What happens here is that the amount of capital that you pay back is slightly different because of the amount of payments and the years and whatever. So rather than talking about straight kind of savings on this one, I've taken your kind of view on this, Charlie, and it's about, right, well, what's the balance outstanding at any given point? So I've run this through the same size mortgage, now repayment, 20-year term. Left-hand side is the situation you'd have with the no-fee product. So work it through over the 2 years. Your balance should be 283,000 and a little bit after 2 years. One on the right, same rationale. So we've got a like-for-like look here. 315. So I've added the fee. I've assumed that the interest cost is going to be the same, and that we've got the product fee added on top. What the mortgage payments are only £345 less per month because of the way repayment mortgages work. And that the balance at the end of the 2 years is 292,114. So yes, the balance is higher. The balance is 860 odd pounds higher, but you've actually had £8,276 worth of less payments to make over the same term. So again, if you're looking at a pure 2-year costing, it's about £370 difference over 2 years. All that's changed is that we've changed an interest cost to a fee. And as a result of that, yeah, we are kicking the value of that fee down the chain a little bit here. But for those who really need it at the moment, that will be possibly, whether it's the interest only or the repayment version, this is the lifeline that could stop someone needing to sell a property. We could have people here that don't have debt, but, and I've made some notes here, we could have people perhaps on temporary low incomes. They've either just lost a job, there's quite a lot of that going on at the moment. Someone could be on extended mat leave, so they have an affordability, but at this stage it may not fit. We've got plenty of self-employed people, like lots of brokers, who are seeing lumpy income, and that actually, given those two sets of figures, say, well, you know what, I'm quite happy to pay a little bit extra if it means that I can at least keep my monthly payments going and not have to worry about selling a property. Could be those on sick pay as well. Look, there are plenty of situations where a Skipton borrower in this circumstance doesn't have a debt problem. They don't actually have 30, 40, 50, 60,000 pounds of the debt and going down the plug hole of that. They could just be at a situation in life that we've probably all seen at some point where they cannot quite afford that big jump up to, if I put it back on the other slide, forgive, there we go. They can't do the £620 jump in payment. So as a result, whilst it's effectively robbing Peter to pay Paul in terms of I'm taking the interest and turning it into fee, it could be enough for someone not to have to sell their house. Now, I get what you said earlier, Charlie, absolutely. Selling it now may be better if the market is still going to keep falling over a period of time. And look, I think we all watch what you say and do, and I think we all have a similar outlook on things. But if you have got that, if you've got that client that is struggling mentally with their family, want to try and keep the roof over the head of their family, they've got a couple of kids, perhaps doing their exams, they're struggling. This is a lifeline for that. Might actually avoid the need for them to hide, stick their head in the sand. I'll tell you what will probably happen, and I'll guarantee this in 2 years' time when we see some stats on it. People will borrow off their credit cards to pay their mortgage. So they'll go down the route of taking the left-hand product, the no-fee product transfer, because actually that's where most lenders are, give or take 0.5%. So down the left-hand side. Don't forget, this is Skipton only, one-off product or one-off range of products. So what you end up with is people actually going into further debt, taking a credit card or a loan, using that to pay the extra difference that they can't pay on the mortgage. And then in 2 years' time, when whatever the situation is, they're going to be in a situation it's like, right, well, we've now got 20 grand on a credit card that we didn't have. Mortgage rates are wherever they're going to be, and property prices are wherever they're going to be. How does that borrower now feel? Oh, I wouldn't like it, definitely. Sure, others wouldn't either. And you know what? That just starts that spiral of debt that you quite rightly talk about, and what we want to try and avoid as best as we can. There will also be people that have got credit at the moment. Let's say they've got, I don't know, credit card. There's not too many 0% around. Say it's something like a Barclays card or something. It'll be high 20s. There we go. Just as if by magic, I have my credit card comparison just ready for this. So I've got that client. He or she knows that they have got other debt that's costing them a lot more than the 3.35 or the 5.99 product we've got. So let's say they're sitting there, they've got this decision to make. It's the Skipton range again. We're here. Right. I've got 10 grand or so outstanding on a 22% credit card rate. Some are obviously much higher. At the moment, I can only afford to cover the interest. And most lenders allow you to pay 2% on a credit card these days. So that's very real. Over 2 years, they forked out over £4,000 worth of interest, and they still owe the 10 grand. And they're trying to keep everything juggling. And they're trying to keep everyone in the household happy, probably apart from themselves. So if we take that example there, we've got, well, what have we got? We've got £344 extra available for my repayment mortgage customer. So dare I say, the worst of the two examples. If they actually use that £344 a month and took the 5% product, they could pay off that credit card a bit quicker, a bit less interest cost. And after 2 years, with a bit of calculation, we've got just over £6,100 left on their credit card, down from the 10,000. What that's actually saved them is getting on for nearly £4,000 in credit on their credit card balance. So if we're sitting there looking at that sheet saying, well, yeah, Justin, but you know what? You've added £8,600 in mortgage balance because of the 5% product, because it's not particularly very good and this, that and the other. What it's done in this particular example, it's allowed him, sorry, wrong way. There we go. We've now saved getting on for £4,000 on the credit card. So actually the net cost of that previous repayment mortgage calculation is getting on for £4,800. It's relieved some pressure. It has kicked a can down the line and down the street for what might happen in 2 years. But it's also given them the opportunity to at least pay some credit off. If the only other solution would be to sell up, Charlie. So let's say we got the client there sitting there saying, well, perhaps I can't afford the 5.99 product, and I haven't got the Skipton one to fall back onto here. So perhaps I'm a little polarized in the options, but that's the bottom line. Then the client is going to have to sell. if they can't find any other long-term solution to this. So if you think about the cost of, in my example here, we've got the £300,000 mortgage. It's going to be about a £500,000 home. I think you quite rightly challenge estate agents to find a 2% fee on a sale. So let's say we got one of your good agents on this at 2% on a £500,000 house. That's 10 grand plus the VAT. That's £12,000. Legal fees to sell, legal fees to buy, stamp duty to pay if they can find a smaller home that's more affordable. Perhaps got to find a new school for the kids. There is a multitude of other costs associated with the exit route. Now, I'm not saying the exit route at some point for this particular customer isn't a sale, and I get wholeheartedly that the price might be a bit less in the future. But to make it a fire sale at a time when there's a lot of stress going on because of the finances, having to go into a market where it's not particularly comfortable, that if anyone gets wind of it being a necessity to sell, they're going to get a low blow offer. To then pay out probably £15,000 for the privilege of that, why don't they just pay £15,000 product fee, take the lower payments, keep the roof over their heads, keep the family unit going, keep the mental health issues away or reduce them as best as possible. Perhaps look for a solution, get a better job, look at stretching it in other ways. Perhaps it might be that you keep the mortgage running as it is, and that extra 15 grand you borrowed, you put it on a quicker repayment plan. It's not that dissimilar to the calls that we get year in, year out of people wanting to debt consolidate a £15,000 credit card, and we tag it on the mortgage, You know, this is just another variation of that.
Okay.
But I hope that's given some context, Charlie.
No, thank you very much.
And that's all I ask. Yeah.
No. Hey, listen, this has been extremely helpful, and I'm very glad that you've laid your numbers out now. I'd like to do a couple of brief reactions, a couple of questions that I want to just leave. Don't answer them now, because Alex, I want to bring Alex in now. He's got some stuff he wants to say, including the fact that actually, okay, I've got a long list of reactions to this, because I don't dispute with any of those numbers, and I knew all of these. I know they're the case, right? But in all of the discussions, it's always, and let's hope things are better 2 years' time.
Yeah, get that.
So it is rolling the dice. And my first big objection is to say that people have a choice, because I don't think anyone who had a choice, for the reasons you have just described, nobody with a choice, with an alternative to this, would take this. They would take the alternative because this is the most expensive of all of them, leaving aside paying down credit card debt, which is a separate what if. And I get that, of course. Everyone knows that if you've got higher interest debt and you can pay it off with lower interest debt, of course that makes sense.
Yeah, get that.
But the brokers have been saying, "Oh, listen, it's just choice." No, I think the people who take this take it because they have no choice. Just my opinion. We'll come back to this. Secondly, I was waiting to hear you say it, and at the very end, you did say it at the very end of your first comparison, which is, yes, they are in more debt at the end of the 2 years than they otherwise would have been. Now, you've got to remember that the debt is what put them in this problem position to begin with.
Well, I would disagree. I'm sorry, because they don't necessarily have the debt. This is an affordability issue, not a debt issue. The affordability of making the payments every month.
Justin, you're splitting hairs, because
slightly different.
It's affordability of what? Affordability of the debt.
The mortgage.
Which is debt, right? This is the point. Their debt affordability was what got them here in the first place, and they're going to have a bigger debt affordability problem 2 years from now. It's going to punch them in the face unless something turns up and they get a higher paid job or something like that. It's and so what I've got to let Alex come on, but it's the false hope that some people will clutch at this and then 2 years later will wish that they hadn't. And I don't think enough emphasis is made on, look, you've got to consider the worst case scenario here. And the worst case scenario here 2 years from now is X. And you've got to imagine that if that is what happens 2 years from now, what will you wish you had done now? Will you wish you had taken out this 5% fee product? Or will you wish you'd done something different, maybe even go down the sale route? Anyway, I've got more to talk about that, but I must bring Alex in now, and then we'll come back to you later for reactions on that.
Sure.
Alex, you there?
Yes, I'm here. Good afternoon.
Good afternoon. How are you?
Very well, thank you, mate.
So, do you have stuff you want to state to begin with on this?
Um, I mean, not a lot. Justin laid it out very well. All I would say is, I think both Charlie and I didn't have as much of an issue with the 40% loan to value at 3.35, because, as you say, the differences there are much smaller. But neither of us, as you also pointed out, could see very many people taking that one. I mean, when you say niche, I'm guessing very, very, very niche. And if they go in with their eyes open, such is life. The one that is a little more concerning is for the people who only have a 10% equity and are looking at the 3.59% rate, because that makes a hell of a difference in terms of the advantage they get in their reduced payments, which is much smaller, and the overall cost of getting that advantage over the 2 years.
I think that's a really, really good comment. And if I can just come back on that, I think that's where working with a qualified regulated mortgage broker to sit down and go through whatever options on the table in that kind of scenario with a 90, 85, 90% loan to value kind of client, in all fairness, this probably goes in the bin and it hits the bottom of it. And you then look at the mortgage charter and you look at other opportunities.
Yes.
Because at the end of the day, the fee, yes, ultimately will create a negative equity situation. So this is where actually getting regulated support and help from the mortgage brokers that are around is absolutely vital, because if they can eliminate it, then you know what we've got? We've got exactly the same playing field for all the customers across the market. All that we're really debating here is four products, I think it is, from Skipton.
Yes, out of 12,000 or whatever.
12,500, of which only half, exactly. So you're right. You know what? It really wouldn't surprise me if in a month's time we got someone from Skipton on here and they said, you know what, we've done 25 of these. They've all been through brokers, and I bet you bottom dollar because of our need to work closer on vulnerability. They will probably be all within the vulnerability category for checking, in terms of either the network will do a file check or we will actually send them off if we're directly authorized to the right people to check, because we won't want to be in a situation where our paperwork and our documentation and the conversations that we've had and everything associated with that case is not watertight. So we would want to make sure it's spot on. For a 90% product, I would be massively surprised if there's any benefit. It's only going to be fee, so bin it.
Yeah.
For those, you know what, I think this is probably going to be more for the higher loan interest only customers. Someone might say Skipton's average loan might be 120,000 pounds, but there'll be enough, probably 40, 50 customers that probably have got 3, 4, 500,000 pound on interest only, because the interest shock of 2% to 6% is massive, in particular on the interest only cases. With the capital repayment, because of the way the payments kind of rework themselves,
it's a little
to ensure the debt's paid off at the end of the term that's set, it softens the blow a little bit. But I think it's the interest only customers in particular, hence why, in all fairness, that was the figures that I put on the social media yesterday. That's where I feel that you might find the 20, 30 customers that say, you know what, that's what I need. I've got some other debt. I've got school fees that I need to run out for another 2 years. You know what? In 2 years' time, I know I can afford this fine, but I've got to go and find some extra money. The government want to put VAT on, or whoever's in want to put VAT on those. And as a result, I need to get the kids through school. I need to see out the next 2 years. And you know what? Debt, absolutely, Charlie, I agree with you. We don't want debt accumulated. But we also have the phrase that sometimes there is good debt out there, and debt for a purpose and debt for a specific. And absolutely right, they've got to understand what they're entering into in conjunction with the right advice. But actually bumping it down 2 years down the line so that, for example, the school fees have worked out the system. It could be that they've got other liabilities which are not necessarily debt related. They've just got to find the money for it. It could be that they bought a car for £900 a month and they've still got 18 months to go. They know it was the wrong purchase, but equally, they can't get out of the contract. There are reasons that people might pick this product with the much lower payment, other than because they've got a load of debt or they're worried about the debt.
I hear that, and those sorts of people are people who are clearly they're in full understanding of what they're doing. But there are a lot of Skipton first-time buyer customers who don't understand all this, who don't run the numbers, and who do just trust their mortgage broker. And what's happening is with this particular product, and because this is the other thing that you didn't mention at any point in your piece before, which is what's the full term cost?
It can be whatever you want at the end of the day, and that's not me trying to that's not me trying to sidestep an answer. But don't right. So first things first, we've said for your first time buyer, 95% Skipton borrowers, this won't be an option. This won't work.
If those guys are already these are the ones that I'm worried about. And when you say, oh, it's only 20, 30 people, to me, that's still a lot of people who could have their lives turned upside down. So,
that'll be those that'll be those with probably low loan to value, with a high spike in their payments. So it could be the interest only or part interest only, part repayment. That's what I'm saying. The profile of the client that would be rightly appropriated to that product, subject to individual assessment by that advisor, will probably be more about the high value, low loan to value than the 90% client. That I think, in all fairness, Charlie, you're the one. You are concerned for that client. This isn't going to be the product for them. I would love to see how someone makes it work, and I don't think they will.
Okay, so
all you're doing is you're putting people back.
I'm going to tell you something, right?
Yeah.
There is, and I'm not saying this is a good thing or a bad thing, but this is absolutely an observation of mine, that there is a culture among mortgage brokers of never looking beyond the end of this, whatever term it's on, 2 years or 5 years. Yeah. There is a culture of not looking at the full length term cost, because for a lot of people, it doesn't matter. As wages go up over the years, their their mortgage payment comes down. And for a lot of people, probably for the majority of mortgage holders, it's not an issue. But for these vulnerable people who perhaps overextended when they did a first-time buyer and perhaps got very lucky with their timing not being good, and so they didn't get equity going up in their property, and they just, and I get so many of my followers messaging me this saying, this is what happened to me last time round. I was stuck. I was a prisoner in my property and with my mortgage for 10, 12, 14 years, and it was a nightmare. We couldn't do what we wanted to do for the kids and the family. And these are the ones I'm concerned about, because they're the ones. Skipton's own press release says it's for struggling customers. Yeah. And if you are already struggling and don't have a very clear and very confident way out of 2 years' time, because I mean, you're right. Someone who's taken on the 900 quid a month car for 2 years, good luck to them. They're going to be all right. What they should do, what they should do is give that car back.
And I think in all fairness, we as advisors would tell them that what you've got to do is go through your bank statement and work out ways that you can cut your costs down. How many people spend £300 a month on Skybet? There are many of it. I think so. But I think
let me finish because you did sidestep my question. I would love to know the full term difference on the comparisons that you gave. So the 300k and the 315k at the end of the 2 year discounted period, they've got another 18 years left to run or something. Yeah. What is the full term difference going to be? Because that's the true cost. And for people who are marginal and vulnerable and are going to be fighting, especially given the projections for our economy now, which most mortgage brokers are in complete denial of. And most mortgage brokers are, everything's fine, Charlie. We're not in recession. It's going to be fine. I'm not saying you're one of those, but I'm just saying there are a lot of people who have this blind optimism and don't look at the writing on the wall, which is that the economy is stuffed for at least 5 years. It's just not going to be any real growth. So I would love you to give us even a rough estimate of what is the difference over the remainder of the 20 years in the two examples that you gave.
I'll work it out on an app. I mean, that's easy. Yeah. All I would say, and please, I'm not trying to sidestep an answer, because look, it is factual.
Well, give me the answer first and then tell me what you're going to say.
Okay, all right. Okay, right. Let's find my mortgage app. So let's put a £15,000 mortgage in at a rate of 5 for 18 years. So that is going to cost you, is it going to give me the answer? Probably not, actually. Total repayment, 22 grand. on that 15,000, because that's the only extra bit of borrowing.
And that 15,000, sorry, that 15,000 is money that the borrower has paid out, right? So that 15,000, remember, is the fee.
No,
And so it's
no,
the fee plus.
Charlie, I've got to correct you. They swapped the cost for the 2 years of about
that.
15,000 for the fee.
Right.
Okay, so you
So
can't
what
say
we have,
that they paid 15
Justin,
grand for
I get it.
nothing. They paid it back.
No,
Okay, they paid it back
I
in different
get it.
things.
But sorry, we know, because your example, can we bring your example back up? We
Yeah.
know your example. So what did you say it cost? 22 in total.
22,000 if you run that over 18
And
years.
go back to that first. Can you go back to the first slide that you did?
Yeah, sure. Hold on. Oh, is it still there? That's the first one. That's the interest only one. So that's the easy calculation version.
Do you have one that showed how much they saved over those 2 years in payments?
Or you got the repayment one. It depends which one you're looking at.
Okay.
So that's a repayment version.
So because the actual cost of this choice is the 22 grand of the total cost of the 15 grand of 18 years, minus whatever they saved here.
Correct.
So the
Charlie,
price.
Can I say that, and forgive, I do need to jump in, because otherwise you might go off on a diatribe that I need to pull you back on. So please forgive. The number of mortgages that will actually run their full term isn't as many as you think. A lot of people will pay them off early. They will stretch them further. Absolutely. And I think you made a very good comment about the number of 35-year mortgages going on. We as brokers, we as customers, whatever, will play a little bit with the term to make it fit budget. We have exactly the same issue around debt con, because this is effectively a version of it. When people keep coming to us and keep topping up the mortgage, and we still got to work out that, I might have paid off a 10 grand credit card, but actually it's going to cost you 21 grand over the term. Which is the right advice? Do I pay off the one that's £600 a month, or is it £25 a month on the mortgage? It's the same conversation, just slightly convoluted and a little bit different, but it's the same fundamentals. The reality is, as the qualified professional advisor to my client, I'd say, look, we've added 15 grand to your mortgage. Ideally, we want to pay that off. Should we put 15 grand of your mortgage on a repayment basis? So at least it's repaid by the end of the term. Can we actually pay it off a bit quicker? So perhaps in a couple of years' time, assuming lots of things are looking a little bit rosier, and I know we're not in control of that, but let's follow that process. We can say, look, why don't we put the 15 grand over 5 years or 10 years? You can do split terms, you can do split methods of repayment. There's lots of ways we as the broker can advise the clients to deal with that quicker. But I get that the worst case scenario is you take it till its fullest. I get that.
Okay, so listen, if I could characterize the overall response I'm getting is, hey, look, there are all kinds of options, and inflating away the debt, and we can refinance it. Yeah, that's for a lot of people. I am concerned about the vulnerable ones, and they may be in the minority, but they're the ones I am out here banging the drum for, because those people don't have those choices, right? And if there are some people who spend their whole life up to their eyes in debt, slaving. I've had people who've contacted me and booked the one-to-one and said, look, we're working full-time, we're in shared ownership. Our interest rate comes to an end 2 years from now. I mean, these guys are forward-thinking. 2 years from now, our interest rate's going to come to an end, and we won't be able to afford a new mortgage. We know we're going to have to sell. We're trying to work out whether we have to sell then or now. We don't know which is better, because we've got to look at the cost of living. So I know, and if one more mortgage broker says to me, yeah, but lots of times you can do this. I know that most people will be fine, but most people will be fine doesn't help the people who aren't fine. And this is such a serious issue, because as I explained in the video yesterday, there are people who end up taking their life over this. And in the video that I put out this morning, which was a documentary done back in 2009 or 10 about those 3 people having their repossessions, these guys, they all overextended. And why did they overextend? Because lenders went, hey, borrow, it's going to be fine. And they lost their homes, and it altered their children's lives. And those people wouldn't have had their lives happen like that if they hadn't been lent more debt and more debt and more debt. So I accept all the things you say about people who are in normal affordability situations, but people who are in unaffordable situations, who by definition are the ones this particular product is for, are more likely to not have those other options and end up being stuffed. Anyway.
Well, like I said, if we talk about Skipton customers here specifically, there are three options for them. This is one of them. And if you're talking about your first-time buyers who bought in the last couple of years and are facing, whatever's come in front of them, this isn't for them, and it won't be. And like I said, I cannot believe for 1 minute any mortgage broker would put their name to it either. So
I'm happy to hear you say that. I'm happy to hear you say
God, because look, we wouldn't want it. At the end of the day, it's financial services compensation scheme. It's probably losing your license. It's losing your livelihood, and that's just for us as brokers, without even worrying about what the effect is of the client.
Justin.
And look, my only question back to you, or statement back to you, is that the product for the right client in the right circumstances, which could be more like the one I've modelled rather than the 95% first-time buyer 2 years ago, that might, how can I put it? The mental health angle is equally as valid because it could stop them having can't stop having mental health. You know what I mean?
Yeah.
Because because what we're delivering here is an opportunity to save money per month for the next few years, whilst a solution perhaps can be found. Right. So actually, this is equally something that can protect against what you're quite rightly looking to protect against too.
Alex.
Hello. Right. Sorry, Justin. Finally.
I found someone who can talk more than you two. Yeah, I know you're.
Yeah, and never stop. What was interesting was you were saying obviously not for first-time buyers, not for the people with only 10%, for the people with 40%, potentially a very niche group. Yes. However, the other thing to point out about this particular mortgage is that the shorter your remaining term, the worse it is.
I agree. And again, it's why you get professional advice to look at it.
Yes.
If it's a short term and it's repayment, you're probably looking at the mortgage charter solutions, which is the interest only option.
Exactly. And so, again, all of the conversation is going back to the point that really there are very, very few people that a mortgage broker would recommend this to.
Correct.
And I don't know how Skipton operate internally and whether there will be a mortgage broker involved in that process who is anything other than a Skipton employee. Or
I think from the information we've been given, it was probably broker only. In all fairness, they may be able to do it internally. But of course, when we have customers that have got financial issues, we are advised normally to either to refer to citizen advice and or the lender, because the lender actually has to train people within their departments to actually deal with that type of scenario. So if we're sitting there with an absolute disaster situation, I know that we have places to put those people. It's not about just shoehorn them into a product.
No. Okay, Justin, just quickly. So what we're saying is this product would really only suit somebody with 40% equity in their property who has more than 20 years on their term.
Or low loan to value, interest only, I think, yes. But I would say, yes, it's a very small proportion of the market. This is not designed for the 95% LTV customers. I can't see how it would fit. And to be fair, no one's ever said it would. That's why my example's at 60%. I think my example is probably more realistic, but you're absolutely right. The volume of people like that is going to be probably 20, 30 customers at best.
So it's really just a headline grabbing, hey, look, we've got low interest rates, we're in the press, and everyone's talking about us.
Well, I think they went out with a statement with the product. I think in all fairness, the number of people that have blown this all out of all proportion is huge. And all that the brokers like me are trying to do is trying to defend the lender. You know what? I probably do 2 or 3 mortgages with Skipton a year. I'm not paid to talk on their behalf. I haven't met a press person here. I'm really talking on behalf of the brokers who are, because of the way it's being reported and the headline fee and how people feel about fees, without understanding the whole product and how it works, which hopefully I've gone some way to do today. But it's almost like we're defending our industry, we're defending our people, and at the end of the day, have trust in mortgage brokers. We are regulated. We are, I spend £2,500 on my indemnity insurance. We've got the financial compensation scheme and every other reason to trust us, not to sell an inappropriate product.
You can no more trust all mortgage brokers than you can trust all estate agents or all surveyors, right?
And that estate agency is relatively unregulated.
Regulation and trust are completely separate things in my opinion.
Possibly so, but you can run one and not the other.
I am not attacking lenders as an industry. I'm not attacking brokers as an industry. I am attacking a very specific product
Yeah.
and saying, hey, you guys that all help lend people money to buy houses and most of the time do a good job, this one's not okay.
Yeah.
That's all I'm saying. And the whole industry has reacted as if to say, don't you say anything bad about our industry. I'm not saying bad about the industry. I'm saying that product isn't okay.
And if I can just extend what you said there, this product isn't okay for the 95% market. You know what? I think you'd have more people going with you. I think it's because you're, dare I say, a little broad brush. And you said this is, whatever the words are, horrible product or whatever, or it's
I call it loan shark.
A loan shark. I mean, that's
loan shark. I said it was like Wonga and Wonga.com,
Yeah.
and I know that's really wound people up. But the point is, it's so important because there are borrowers out there who don't have what it takes to crunch the numbers and who will just trust a broker that says, hey, this will reduce your payments for a couple of years. You'll be in more debt 2 years from now. You might be worse off 2 years from now. And that's my point. And there is something really icky and and dirty about this 5% and we'll add it onto your loan. Off you go.
Right.
You'll be fine. It's just not
I think
okay.
as long as there was balance, Charlie, I think that's all that we asked for. That look, there is a product in the nicest sense to Skipton, and I'll say this quite clearly: 99.9% brokers wouldn't like to put their hand up and say they like the product, but it has a place. So if you said, look, this is not a great product for first time buyers or those who bought a couple of years ago, I don't think you'd have anyone disagreeing. All I think we would say is, look, if it is appropriate, let the mortgage broker with all that protection and insurance around them, let them do that bit. If you can talk nice and loud about the property market and what we got to do and how we got to get things done, fantastic. You're entitled to opinion, absolutely, but the appropriateness of this is probably for 30, 40 customers in with a specific profile, with a specific need. It won't be the people that you're quite rightly trying to protect.
Do you know how many people had their homes repossessed in the last downturn? It was a lot more than 20 or 30.
It might well be. Yeah. And you know what? Sorry, go.
I've got a comment here from someone who I haven't heard of before called Katie Eatonton on LinkedIn, who, judging by the letters after a name, is a form of
mortgage broker. Yeah.
Mortgage broker, right? So it's not actually that bad. Not loan sharks. Would love to hear your comments now, Charlie. Katie, I have enjoyed this conversation. That particular product, I still find unacceptable, given that they state it is for people who are in difficulty already, right? So my position remains utterly unchanged, because if someone is in that much trouble, unless they've got very high confidence levels of being in a better position in 2 years, but they must be, unless that's the case, then what's happening is Skipton are going to make a very nice extra income over the period for lending, for increasing the debt. They'll get more money out of it. They will make more profit out of this on the back of people who are in distress. Not okay. Now, there are lots of other ways that Skipton could help those people in that position without increasing their debt level. Now, it's again, I'm not a product designer for mortgages, but there are other ways. This, I know from an accounting point of view, would be great business, and also might just help kick a few repossessions down the road and make things not look so bad for Skipton. Now, you might say I'm being cynical here, but genuinely, if this product means that their customers cling on a little bit longer, because this all happens at the end of every downturn, people just they cling on a tiny bit longer, as long as they can, and it just gets worse and worse for them. But in the short term, this looks good on the P&L for Skipton. It looks good because it will reduce repossessions. It will, if compared to if they couldn't afford it. These things are also true, Justin. I'm not disputing anything that you've said.
All I'm saying is that you're still talking about for this particular product, a very, very, very small subset of people. At the end of the day, this is the whole issue that you're quite rightly talking about is for 120 lenders to debate about how they can find different ways of helping customers. And look, your passion to help them is without argument at all. I think the people in particular you want to help, which quite rightly is your vulnerable 95%ers who have come into this market on rates of 1%, and suddenly they're staring down the barrel. The mum and dad lender that supported them is now having to support them again, and probably will have to support them further. And that wasn't expected. Totally get that. I think all that we're saying, or what I'm saying, I guess, is that this particular product that you're labelling is not for them at all. It's for a specific subset of customers where actually there are some choices, there are some things that can be done differently, that perhaps they are in a position where they can kick
That's
the
not
can
what
down.
they said in their press release, though, Justin. It's not what they
Well,
said. They said who it was for. They said it was for struggling customers
yeah.
at risk.
And you know what? If it was me, perhaps I'd go back knocking on the Skipton door and just say, look, I think your press release has possibly triggered off something that you didn't need to. And that with the right wording, with the right framing, perhaps, well, one, we may not be on this call. Secondly, we may not be fretting over what might only be something for 30 people in a world of what? How many people we've got in the UK? 80 odd million? I can't remember now.
All right, Justin. Well, listen, thank you very much. I really appreciate this. This was, and I hope this was a really useful video for people to watch as well.
I thank you for the opportunity of coming on, and like I said, I'm not talking on behalf of Skipton, I'm talking on behalf of brokers. So, we're trying our best to help.
All right. Okay, guys. Alex, have you anything else you'd like to add in at the end here?
No, that's covered it.
Cool. Well, listen, just over an hour. Let's knock on the head. And nice to meet you, Justin. Nice to have a conversation.
Same here.
And I think if all this debate has done, this videos and this hornet's nest that I've kicked has done, is made a few brokers who might have not perhaps thought through the longer term things, made them think a bit more carefully about it. I'm glad that if it's done that, then that's great. I mean, it certainly hasn't done any harm. Who have I haven't attacked any people. I've attacked a product. That's all I've done. So I will always do that if I think if it needs it. But thanks for coming, and maybe we'll see you again soon. Cheers, Justin.
Cheers. Guys. Thanks.
Thanks for watching, everybody. Much appreciated. Have a great weekend.